mentioned volatility. It doesn't make any difference to us whether the volatility of the stock market, is averages a 0.5% a day or 0.25% of a day or 5% a day. In fact, we'd make a lot more money if volatility was higher because it would create more mistakes in the market. So volatility is a huge plus to the real investor. Ben Graham used the example of Mr. Market, which is we've used it. I've copied it in the report. I copy from all the good writers. And Ben said, just imagine that when you buy a stock that in effect, you've bought into a business where you have this obliging partner who comes around every day and offers you a price at which you'll either buy or sell. And the price is identical. And no one ever gets that in a private business where daily you get a buy-sell offer by a party. But in the stock market, you get it. That's a huge advantage. And it's a bigger advantage if this partner of yours is a heavy-drinking manic depressive. I mean, the crazier he is, the more money you're going to make. So you should, as an investor, you love volatility. Not if you're on margin, but if you're an investor, you aren't on margin. And if you're an investor, you love the idea of wild swings because it means more things are going to get mispriced.
Risk.
Yeah, we regard volatility as a measure of risk to be nuts. And the reason it's used is because the people that are teaching want to talk about risk, and the truth is they don't know how to measure it in the business. I mean, that would be part of our course on how to value a business, would also be how risky is the business. And we think about that in terms of every business we buy. And risk with us relates to several possibilities. One is the risk of permanent capital loss, and then the other risk is that just an inadequate return on the kind of capital we put in. It does not relate to volatility at all. Our See's candy business will lose money depends on when Easter falls, but it'll lose money in 2 quarters of the 4 quarters of the year. So it has this huge volatility of earnings within the year. It's one of the least risky businesses I know. You can find all kinds of wonderful businesses that have great volatility in results, but it does not make them bad businesses. And you can find some terrible businesses that are very smooth. I mean, you have a business that did nothing, and its results would not vary from quarter to quarter, right? And so it just doesn't make any sense to translate volatility into risk. If somebody starts talking to you about beta, zip up your pocketbook.
Finance department teach that volatility equals risk. Now they want to measure risk, and they don't know any other way. They don't know how to do it, basically. And so they say that volatility measures risk. And I've often used the example that the Washington Post stock, when we first bought it, had gone in 1973, had gone down almost 50% from a valuation of the whole company of close to say 180 or 175 million down to maybe 80 million or 90 million. And because it happened very fast, the beta of the stock had actually increased, and a professor would have told you that the company was more risky if you bought it for 80 million than if you bought it for 170 million, which is something that I've thought about ever since they told me that 25 years ago, and I still haven't figured it out.